you would have a portfolio, and at the core of that portfolio, you would want to track a market index. You could use a passive ETF there. Access the market as cheaply as possible and as efficiently as possible. But you want to outperform the benchmarks. You want to maximize returns over the long term.
We're looking for alpha.
We're looking for alpha.
Hello and a warm welcome to yet another fantastic episode of our JSE Investor Avenue podcast series. Now, today we're joining you in conversation to talk about a topic that has many South Africans pondering. What is it? How does it work? And how does it compare to what I already know? Actively managed exchange-traded funds. Now, if you've joined us for previous conversations, you'd be well aware that we gave you a 101 introduction to ETFs, largely from a novice investor's point of view, right up to more professional and established investors. But the truth is, when it comes to the landscape of exchange-traded funds, they've certainly evolved over the years. And today, we're going to get some insight into actively managed ETFs, how they work, what the global trends are, how we get access to them, and of course, understanding the dynamic that they bring to the growth that you can anticipate in your portfolio. For this conversation, I'm joined by Eva Madjarova, who's the head of institutional business at Signia, to help us unpack more of this theme. Such a pleasure to have you with us.
Thank you so much for having me.
I'm excited for this conversation because many of us typically think, hold on, when we think ETFs, it's all about passive investing. Active investing is something that's completely different, where portfolio managers are consistently hands-on. So maybe help us just unpack the difference and the understanding of what actively managed ETFs actually is.
As the name suggests, actively managed ETFs are actively managed. So you're correct in saying that it involves active management. And these instruments came about because really there was a need for marrying the efficiency of ETFs with actively managed portfolios. So actively managed ETFs, or we can call them AM ETFs for short, these are instruments that are traded on stock exchanges, so they're listed on stock exchanges, trade throughout the day, just like the ETFs that you may be familiar with, but the underlying strategy is not to replicate an index. It is actively managed. There's a portfolio manager or team that will decide on exactly what stocks or bonds or other instruments should be in that portfolio. And the aim is to outperform whatever they are benchmarked to.
100%. We're looking for outperformance and we're looking for various sectors that we can invest in. Maybe give us some insight. Is this, I guess, any different from an ordinary portfolio that would be listed? What adds the, I guess, dynamic that makes it similar to an ETF in terms of its activeness being listed?
So what is similar to the ETF is the fact that it trades on an exchange. So if you compare it to a unit trust, the unit trust would only be priced once a day. It's not listed. You would have to invest via different platforms or directly with the management company, whereas an ETF you could get via a stockbroking account or various platforms as well. But it's really the tradability, the liquidity throughout the day, that is what I believe is attractive for investors. And transparency, let's not forget about transparency. A typical actively managed portfolio that may be in a different wrapper, such as a unit trust, you won't necessarily know exactly what is in your portfolios. And ETF investors like the transparency of the instruments. So on a daily basis, if it's a fully transparent, actively managed ETF, you could go and have a look at exactly what is in that portfolio.
Got you.
There are semi-transparent ones as well that would only disclose the holdings quarterly, but the transparency is still there quite regularly.
Got you. This is important because we've got transparency, we've got the opportunity then to make sure that we are invested in a diverse ETF, and of course fundamentally making sure that we are looking to outperform not only the benchmark but maybe even the index at times. What have the trends been when it comes to actively managed ETFs from a local and global point of view?
The growth has been huge, both globally and locally. Locally, we've only been able to list actively managed ETFs on the stock exchange since late October 2022. So it hasn't been a very long time, but we're seeing, I think, about 26 listings already. just in the actively managed ETF space. So the growth has been phenomenal. And globally, we have officially surpassed $1 trillion US.
Sure.
And BlackRock estimates that in the next 5 years, by 2030, the actively managed ETFs, assets under management, will exceed $4 trillion. So the trends that we are seeing is definitely a lot of flows and a lot of different listings. And that is in response to investor appetite, the appetite for these efficient instruments that are transparent and that are giving us the opportunity to outperform.
Got you. So the output's been great, the uptake, I beg your pardon, and of course the opportunity to actually see a wider number of actively listed ETFs listing locally and abroad. For someone who might be watching at home and thinking, hold on, it almost sounds as though I've invested in this ETF and I've got this magic magician and full-time portfolio manager making sure that they monitor the movements. Maybe help us understand also how competitive they've been in the landscape. I ask this because typically markets are volatile and there's certain stocks that might be in favor versus other sectors and the like. So does this also prove that actively managed ETFs provide a heightened level of not only competitiveness, but even growth in one's investment portfolio?
I do believe so. I do think that there's a place for both, though. And if you look at pure theory, the theory will tell you that in a very efficient market, it's very difficult for active management to outperform passive. So I think that
Tell
investors...
us why, maybe, just to get some clarity on that one.
Really, so market efficiency is about information about companies being available in a timely manner. So the argument is that if information about company X is available to all of us at the same time, neither of us would really be able to forefront the other one and have, you know, that edge that will say, I know something more than the other, and therefore in my portfolio, I'll be able to buy the correct stocks that will give me that opportunity for outperformance. And in a less efficient market, arguably, there's more room for portfolio managers to make these active decisions and have the opportunity of outperformance because information may not be as readily and timelessly available to everybody at the same time.
Got you. I'm assuming that even more so, not all of us know what to do with the kind of information, right? Because essentially a portfolio manager or an actively managed ETF comes with someone who's an expert in saying, okay, this is how we're going to, view the valuation of the stock or the company or this particular sector. These are the projections that we see in terms of its performance. So there's a heightened level of having someone who's hands-on and, of course, understands what they're doing.
Yes, and then there's volatility. Yes. Again, arguably in a volatile market, active management should add value. An active manager should be able to avoid risks that may be obvious, whereas in a passive portfolio, those risks may or may not be, as quickly avoided. So I do believe that there's a place for both, and investors should really consider their risk appetite, time horizon, where are they investing? Is it more of an efficient market or inefficient market? What is the market volatility about? And combine the active and passive strategies.
Got you. And this is important because as you're highlighting, not only does it provide the world of opportunity for further growth in terms of your investment portfolio, but it's a really bespoke approach. And I do want us to go back to the comparison that you made regarding actively managed ETFs versus unit trusts. And maybe just take us deeper into underscoring the fundamental differences that exist here.
In South Africa, they are regulated similarly. They are both collective investment schemes. So an easy way to understand it or to describe an ETF would be an ETF is just a unit trust that is listed on an exchange. So from a structure and a regulatory perspective, they are the same. The one is listed, the other one is not. The big difference is, of course, the pricing once a day versus continuously throughout the day, and then, of course, the transparency.
Speaking of this, what about the costs? Because typically when we as retail investors hear about something being actively managed, we assume that there's a heightened cost factor here. Is that the case?
If we had to start with the lowest cost to the highest cost, the lowest cost would be your passive ETF, then your active ETF, and then your unit trusts. And the reason for that is there is a higher premium to be paid when an active management approach is taken, because there's research, a lot more effort into what will go into the portfolio. But actively managed ETFs, both locally and globally, are priced lower than your typical unit trusts. And we looked at a lot of data. So actively managed ETFs are somewhere in between.
So there's growth, there's openness, there's competitiveness, and as you said, transparency, which is so important. And maybe we do need to just underscore that again, especially for retail investors who might want to have a sense of comfort in terms of understanding how to view the costs, and of course, fundamentally making sure that the growth in their portfolio surpasses the costs fundamentally.
Definitely. The costs are always important. The fact that actively managed ETFs are very competitively priced is a benefit. Ultimately, investors earn the net fee return. And in terms of transparency, being able to know exactly what is in your portfolio is a huge benefit to investors. We're finding that more and more investors want more information. They take a very keen interest. They're reading the news. They want to know, is NVIDIA in my portfolio?
Yes.
And now they're able to see exactly what is in their portfolio.
Exactly. So we've got a strong foundation in understanding what AM ETFs are, how they work, and how they differ from the likes of unit trusts, and of course how competitive they can be in terms of adding even more value to your portfolio. But Eva, I want to take this home maybe and bring you and your experience closer to the conversation, especially just in terms of what the innovative solutions you've brought about as Signia, given the business that you represent, in terms of actively managed ETFs, the uptake, putting the portfolios together, what goes on in the secret sauce, monitoring the trades during the course of the day. Maybe take us into that world of excitement that we as retail investors might not often be able to see.
So the 3 actively managed ETFs that we have listed on the Johannesburg Stock Exchange are all very exciting. One of them is healthcare focused. And in the healthcare space, no 2 companies are really the same.
Right.
You've got some that are in the weight loss drugs, which have been very exciting and very topical. Others are in different R&D or cancer type of research. And the portfolio managers can add a huge amount of value by being able to research, where is money flowing, what companies are able to, make profit or turn profit over the next couple of years. In the other space, we've got a fourth industrial revolution, actively managed ETF. Again, a hugely exciting.
There's a bit of AI, there's tech.
There's tech, there's cloud computing, there's drones, space exploration, all the exciting themes and sectors. And again, a huge opportunity in the active management space to be able to, look at the landscape, see where money is being spent in terms of R&D, and try to position the portfolio correctly for the future. And then the most popular one of all is the Fang.ai, actively managed ETF. And again, in the AI space, a lot of opportunity, but we've recently seen with all the news flow around DeepSeek.
That new AI platform from China.
Exactly. The amount that you spend on R&D is not necessarily equivalent to the output. But a lot of opportunity in that space, and a lot of opportunity for active management in that space. We believe that you don't want to be tracking just a benchmark in that space. You really want that insight and deep dive into the actual companies.
Definitely.
That will be the ones of the future.
And this makes it more practical because, as you note, those are key sectors where we've seen a lot of movement, a lot of news flow, a lot of innovation as well when it comes to the day-to-day market flows as well as news headlines that these businesses actually bring about. But let's also take it into the interactions with investors. When we think about actively managed funds and the various sectors and stocks that you've mentioned, we typically think, oh, that needs institutional investors with deep pockets. Maybe paint a picture in terms of the appetite from an institutional investor point of view and where there's still opportunity for retail investors to get into the market in actively managed ETFs.
Actively managed ETFs 100% have a place in the portfolios of both the retail investor and the institutional investors. And for both, I would think of portfolio construction in what we call a core satellite approach. So whether you are an institution that has, huge amounts of pension fund money or balance sheet money or, medical aid sort of money, you would have a portfolio, and at the core of that portfolio, you would want to track a market index. You could use a passive ETF there. Access the market as cheaply as possible and as efficiently as possible. But you want to outperform the benchmarks. You want to maximize returns over the long term.
We're looking for alpha.
So the core of your portfolio could be passive, but as satellites, take opportunities in various themes. Think about thematic investing. Think about regions. And that's where you could use actively managed ETFs. And for the retail investor, it's the same. Look at your overall portfolio. Gain market exposure as cheaply and effectively as possible. MSCI World ETF, let's say. Passive, global, world exposure. But maybe you really believe in these weight loss drugs. Get some healthcare. Maybe you really believe in AI. Get some thematic exposure to different themes, different markets.
I like how you've described this strategy. It's almost like a universe of getting the fundamentals and the basics in place, and then the satellite approach, as you say, of tapping into sectors and industries that might not match your risk appetite, but could be worth the gains in the long term, and still following through with the strategy that you have in place. It might sound complex for those who are hearing about this for the first time, and they might feel overwhelmed with really trying to wrap their heads around tracking not only the ETFs that are listed in South Africa from an active point of view, but even those globally. So where does one start when it comes to looking for information?
A quick internet search is always very useful. If you're looking for the instruments that you could get exposure to in South Africa, you could go into the JSE website. I find the ETF SA website very useful as well. You can see a full listing of the actively managed ETFs, the passively managed ETFs, actively managed certificates, with a very short description. But from there, you could then go onto the issuer's website. So if it was an ETF listed by Signia, for example, you could go into the Signia website, and there you will be able to find fund fact sheets, prospectus documents, and even the constituents. So a download of exactly what does this portfolio look like?
Yeah.
What would I be holding? Track record. Who's the portfolio manager? Has the team been stable? I mean, all of that information you would be able to get on the website. And who the portfolio manager is important in the actively managed space. Is it somebody with experience, somebody with a long-term track record? So that's very important.
Definitely.
And
sounds
then
like
fees.
And the fees.
The fees will be
exactly.
on the websites as well.
I like it, the full transparency. It's almost like getting a packet of your favorite sweets and actually having all the details and the ingredients written on the back. Before we wrap up, I'm keen just for us to get a refresher and key points that we do need to keep in mind as investors when it comes to AM ETFs. Are there some aspects that we do need to keep in the back of our mind, whether it's implementing our own investment strategy or speaking to a professional on the other end to actually say, this is the strategy I'm looking for and this is how I believe AM ETFs can play a bigger role?
I think it's important to always monitor once you've invested in the strategy. So monitor whether the portfolio manager is sticking to the objectives. So it's important to, especially in the active space, you could have somebody that has gone in a certain direction and maybe the portfolio is not suitable to your overall strategy anymore. whether there's a need for rebalancing is important to consider as well. And I mean, ETFs, whether they're actively managed or passively managed, should definitely, form part of an investor's portfolio because of the transparency, because of the efficiency, and because of the lower comparative costs.
Mm-hmm. So definitely one for us to incorporate into our investment strategy. And as you've heard, there's a world of information that's available out there for you to actually tap into and find the necessary resources for you to be mindful of. And again, maybe as we close off, this speaks to novice investors right through to those who are well mature and even industry experts. And I'm keen to understand if there might be lessons that both could learn from each other or key takeaways that both need to be mindful of.
I've always been of the opinion that ETFs are the perfect instrument for a novice investor because in itself an ETF is diversified. You are buying into a basket of securities. So by investing a very small amount just into one instrument, you could gain exposure to hundreds or thousands of stocks. So I do think that from a suitability perspective, they make sense for both the novice investor and the very experienced investor as well. In those aspects, they would know what they're looking for. And these days, you can access very niche and very interesting and exciting sectors in the ETF space, both in the passively and the actively managed.
Fantastic. Here's to expanding our universe of investments, as you've mentioned, by tapping into those opportunities and really a part of a strategy that can be implemented for all. Thank you so much for your time today, Eva.
Thank you very much for having me.
Excited to have this conversation with Eva, who's joined us, Eva Madjarova, who is the head of institutional business at Signia, helping us unpack all the dynamics regarding actively managed ETFs. Now, remember, if you have any questions related to this particular topic, be sure to jot them down in our comments section, and we'll be sure to make sure that the team gets back to you with feedback. And there's a lot of information out there. Do make sure that you log on to the JSE website and that of its affiliates to make sure that you get all the necessary information you need on AM ETFs. Until next time, from myself, Gugulethu, Mfuphi, and the team, have a good one.